Everyone, thank you so much for joining us today for the Q3 portfolio performance review and outlook. Obviously, it's some tough months ahead, so it's going to be an interesting one, and look forward to what Mark and Sam have to say. Just some housekeeping. Please do, for those that have just joined us, please do keep your video and your microphone off for the duration of the presentation. And then we'll open up the floor to in the Q&A session right at the end of the presentation of Mark and Sam's presentation. And you're welcome to ask questions to Mark and Sam. You can also pop your questions in the chat on your bottom right corner, and we'll then get Mark and Sam to answer those during that Q&A session. Right, well, without further ado, introduce Mark Inslee, founder and managing director, and Sam Hallett, who's our investment analyst for Cape Berkshire Asset Management. Welcome, guys, and thank you so much for having this or for hosting this webinar for us. And I'll hand it over to you.
Thank you very much, Sean. Yeah, apologies in advance if I sound a bit fluey. I do think I've got that thing we used to have before COVID of the flu, but yeah, didn't want to delay this this webinar, so yeah, dealing with that today. So yeah, just as Sean said, we're rotating between Sam and Shungrai on these presentations now. Both sort of sit part of the CBAM team, but I'm sure many of you attending will also know Sam from the debt side of the business as well. So that's myself and Sam. Yeah, just as ever, declarations for the presentation. You know, no strict investment advice will be given on this for clients or those that are not clients, but that's just that waiver there. Today, what we are going to do is shorten the presentation and open the floor for questions. Many of you hopefully will have had contact with advisors, be that myself, Claire, Katrina, or Greg. But yeah, you know, perhaps there is more direct questions on parts of the outlook that we're not looking at. So yeah, as Sean said, we will open the mics fairly swiftly because yeah, we've deliberately not made today's presentation a long one. As I'm sure many of you have seen from the performance reports, you know, it probably again has been the toughest quarter managing assets, you know, since I set the business up. And as much as it was a good start to the quarter, you know, really sort of, you know, has been a challenging one the last 2 months, as we'll come on to. So yeah, we'll kind of just go straight into the performance numbers that you know already have been published, but can look at them in more detail. Factors in those performances, I'll hand over a little bit more to Sam. Our outlook and strategy on particular themes and graphs and things going on. You know, we've probably positioned that a little bit more around, you know, where do we see the bottom, if we have reached the bottom, etc., and graphs and stats that we're looking at. Sorry, I didn't click that. Apologies for that. Yeah, we will be looking at outlook and strategy, where again, you know, bringing you some of the graphs that we're looking at from a historical basis and, you know, intraday basis on you know, where previous bottoms have hit. Every bottom is different. Every set of, you know, recessionary or market pullback environments, you know, often have a different clause. You know, inflation really has been the trigger of this one. I'm sure as many of you have been reading, and we'll again sort of give some views and open the floor for questions on that. So yeah, moving on to portfolio performance for the CBAM portfolios. So yeah, as alluded to, another tough quarter. As you can see there, the quarter actually started fairly positively. There was a big risk on rally in July. That was all triggered from the first non-rising CPI print from the US. But yeah, I think the end of the month has really just sort of gone back to the factors at the end of Q2, with still concerns around the length of this rate rising cycle and inflationary cycle. So yeah, as much as there had been rallies, and again, I think looking at this graph, it is just again a reminder that when markets do come back, we are expecting to see those very sharp rises. And again, clients often ask questions sort of on the advisory side around, can we sit in cash? Should we sit in more cash? And in my opinion, that's always no. If you're going to ride the cycle out and leave this money invested, tilting towards cash, absolutely is a strategy. But it's in missing those July to August rallies that actually cost you a lot more in the long term, and that's what we don't want clients to miss. I always sort of say clients on the reverse of that graph wouldn't be selling their portfolios at the top. They'd be wanting to keep growing and keep extenuating gains, and that's kind of the way it is. So when we're in these bottom trough periods, it's important to not miss that rally. Is that rally going to be next week? Is that rally going to be in 4 months? We'll give some more views on that later in the presentation, but that's always the hard thing to exactly pinpoint. So I guess very much a positives and negatives on the left and right hand side of this chart. So again, just purely drilling down to Q3, where there were bright sparks. A lot of money has continued to flow out of China, which has affected our portfolio, and for some, India has been the replacement of that. And again, they just seem to be sort of missing lots of the factors. Oil's come down to a manager level, so the oil exposure we hold in the EM and direct has had a good quarter. Clean energy has come off those highs now, as rate rising concerns have sort of come back to that, but that had an incredible run, especially in the first month and a half from the quarter. We've made a slight reconstruction of that, as we put a note out on earlier in the month, where we've rolled our clean energy position, our 8am focused, and introduced a new global thematics fund. We sort of bundled those three together as a thematics portfolio. And again, I just think the returns of assets like that can be very non-correlated to the rest of the portfolio, show the importance of trying to look through the next year, 2 years, whatever it might be. I'm not putting an exact number on that, and going back to themes that were like very in demand, and developments in AI, they haven't disappeared. They will be back. We still need to keep client money invested in these things, and I think clean energy is just a reminder of that it has had a really good year-on-year period. The high yield bond fund is a bit of a misnomer there. We do hold it, and it has reduced those returns, but it's the only bond fund pretty much that's non-hedged. I touched on the global thematics. We haven't held that the whole quarter, but it's had a very good start since we brought it into the portfolio. It's just behaved very differently to other areas, and we bought it at massive discounts. Some of the constituents of that, the digital assets, the hydro, the semiconductor, were down sort of 50% when we apologies, when we added it. So that's probably the positives. They're not the biggest positions in our portfolio, but there are areas that we've chosen to bring in over the last few years with their growth potential in environments not like the current environment. On the negative side of the portfolio, probably China has been the biggest negative of the quarter, and that's important for the portfolios because we are overweight China. We are, as Sam will comment on a little bit more, tracking the Congress in Beijing. Was it Shanghai? One or two.
China.
In China, which again we're either expecting some strong statements on COVID policies and things to come out of that, but yeah, your markets have been leaking in the run up to that particular conference. So again, China's probably been the worst performing fund on the month, and the portfolio is reflected there. Myself and the team are still on active calls to the Hypnosis Fund. Happy to take questions on that later in the portfolio, but yeah, that's That's had pressures from interest rate and debt repricing, but we've had reassurances that debt has been repriced. So to a degree, we're scratching our heads a little bit as to why that hasn't had more of a recovery the last 10 days than it has. I think it's trading at about a 40% discount to the net asset value of the assets in the fund. But yeah, hopefully that's a bit more detail on the biggest wins and losses in the quarter. Again, we'll send the presentation out after, but those are some of the trades that I've talked about there. Bringing the thematic fund in, Ruffer we bought into portfolios 1 and 2, and we'll adjust further in the rebalance that's going through at the end of this week. We fully moved into the same share classes on portfolio 1 and 2 in the American position, and we've added Hypnosis to that list. That's additions. In addition to that, the last week or so. I'll let Sam take over in a minute here, but we do track ourselves obviously versus a benchmark of nine other multi-asset managers. So these numbers do make room reading, and we're fully aware of these. We track them on a daily basis, and it was only November the 18th last year that this portfolio was 4% ahead of benchmark. So the swings in these numbers has been really, really dramatic this year. We think the next slide explains that to clients as we've been trying to come across on calls. We tried to take the cautious approach back in 2019 when the pound seems a very long time ago, but when the pound was strengthening versus the dollar, and clients were asking us, why is the asset value of our portfolios going down? Everything seems okay, markets seem to be going up. Yeah, at that point the pound was rallying 10% against the dollar, and clients were having flat or returns that was confusing them. So that's always been our logic in having this dollar hedge fund. So as lots of clients have asked me the last few weeks, we're not taking like direct derivatives or equity positions ourselves. We don't want those levels of sophistication in the portfolio. Our exposure to currency purely comes in the decisions of a fund manager, and obviously those are our decisions to hold that fund manager, but it's not us physically executing forex transactions on a daily basis that has caused that. But I think as I hand over to Sam now, I think this chart here, if you compare that back to the last chart, this has just been the effect of the US holdings of the currency on a year-to-date basis. So 5.2% of the return adverse to benchmark, we put down simply to the fact that we're not running a dollar position on those US holdings. We're running a sterling position, which if things were going the other way, we wouldn't be increasing, but we'd be fully protecting against everyone else's portfolios going down. Hasn't been the right position year to date, but that really does give the perspective that if you add 3.71, these two portfolios are actually up year to date. So if you take out the effects of that dollar position on our US equities, these, I think, first three portfolios are actually up year to date. They're not up in the real, in the real world, and we'll always track ourselves versus benchmark, but we hope that was a useful slide because it has been the key question. The clients have been asking me in advisory meetings, and ultimately what are the factors that will change it. And in our outlook slide, that is something that is going to continue to be talked about for the next 2 years, really.
Yeah, I think the hedge has been, as Mark very much alluded to, quite a significant negative to our performance, unfortunately, this year versus benchmark. The thing that I would say is that obviously there was a lot of discussion, debate within the team about this immediately post the mini budget of a couple of weeks ago. It feels like that's been a very long couple of weeks in the markets, as I'm sure you can imagine since then. But what was quite interesting in the immediate fallout of that was that we were having a series of investment banks releasing their thoughts, their commentaries, etc., and their forward projections with regards to US dollar sterling currency pair. And what was quite interesting was two factors. One was that people were starting to talk about within 12 months looking at high teens, so like 119 to low 121s, which is obviously around a 10 to 13% increase from the current position of that currency pair. The other thing was as well was that people were starting to talk about there's a point very much close on the downside. So if it were to drop down a little bit more, that they would start buying sterling. It would appear attractive for them to purchase. The reason why that's attractive is that we start to see that there's a bit of a floor there in terms of how far down sterling can go versus the US dollar. And therefore, that helped to give us a bit more confidence with regards to this hedge, which has hurt us so far year to date. But moving forward, will hopefully be more of a positive addition into the portfolio. So when we look at what's been affecting Q3, I'll just go through a little bit of kind of like a timeline almost of how it played out. I almost wish I had the chart here of the performance because you could really see clearly how it happened. So every quarter we have very much an earnings season, and this started off very much in a positive fashion in the sense that earnings from the US in particular were proven to be more robust than initially thought, and that this as a result started to help propel people saw that there was within Q2 that US equities had been oversold, and therefore people had started purchasing some more US equities, and that started to propel this rally. Then what we started to see, as Mark alluded to, is we started to see the first bits of information of we may have hit peak inflation, particularly in the US. So in the US, they are far more self-reliant in terms of their natural resources, etc. So what happens is that their energy supply costs ended up falling a lot sooner than over here. This is actually going to play out into Q4 as well for a key reason, which I'll explain in a minute. But what that has meant is that as those inflation figures have started to look like they're coming down, obviously that has then resulted in energy futures further in the future dropping, because we see a bit of perhaps a demand drop as well, which has helped push confidence and that bull risk on rally up a little bit further. Then we reached mid-August, and this is where things started to turn around a little bit. We had a good 6 weeks of rallying, what we would call a bear market rally. However, the Purchasing Managers Index data, so that's basically a survey that gets done across business managers every month or quarterly. We started to see that confidence within businesses was starting to drop at this point, and that the interest rate rises that have been started from the beginning of the year was starting to have an effect in managers' investment decisions in terms of where they deploy their capital, etc. So that was what then started this reversal in confidence within the markets. And then we've got this odd thing at the moment where the jobs data you would have seen yesterday in the UK that we're at record levels of record low levels of unemployment. The same is happening pretty much across all developed economies. They're proving to be too good. The reason for that is that basically is that this is one of the key bits of data that everyone is looking at to see whether or not the rising interest rates are having an effect in the market. And it's not until we start to see that jobs data not be as good that we will probably start to see the end of this hiking cycle. So that's very much one of the things going into Q4 that we're keeping very much an eye on. When that information in Q4 starts to get a little bit worse, you probably actually oddly will see a rally in the markets, even though the macroeconomic factors that actually look a little bit worse. It's a little bit perverse. But what does that mean? So as I said, because jobs data has proven to be very sticky, too good, it looks like the interest rate rises are going to be higher than initially thought, and they're going to be for longer. So that's particularly important, the longer parts when it comes to equities. If you saw in the notes that have gone out over the last couple of days. I touched on, or Mark touched on, talking about discounted cash flow modeling. And basically, this very much feeds into that in terms of how the markets value those future cash flows that companies are projecting. Those higher interest rates mean that those perceived to be worth less. So that really affects the value of companies, particularly growth companies, and those have very much been pushing up the markets over the last couple of years. Then further, more continuation of something that's been happening all year. The dollar has been increasingly strong. This isn't just a sterling issue. This has been very much a global issue. So I could go back just 2 slides. As you can see from this table on the left-hand side here, pretty much all major currency pairs have been really having trouble with the US dollar. This is something that we see carrying on for a short period of time, but 2023 is likely to be a little bit different in this regard, as the US Fed will probably start, well, we're very confident that they will stop raising rates in 2023.
And cut, which again, from a currency perspective, we are where we are, but if the US does cut rates, we can't see sterling much strengthening.
Exactly, completely, yes. Yeah, that is a very good point. It's really, really important.
So yeah, conscious I do want to have these presentations always longer on with lots of slides. So yeah, outlook and strategy.
So yeah, so looking forward for the next quarter. So first of all, obviously inflation is a really key important factor because of how that feeds into base rate expectations. So what we just see here is that inflation is starting to feed down a little bit. People are starting to believe they may start to fall quicker than it was initially thought at the beginning of the year. So this isn't a very clear slide, but this is how the market is currently pricing in inflation, well, over the next 40 years, which is a bit extreme. But the bit that we're looking at in particular is over the next 5 or 10 years. As you can see, the 10th of October line is actually about 1 down the bottom, and there's expecting inflation at present to fall down to a more palatable between 2.5% and 3% between 2.5 and 5 years' time. So obviously that isn't immediate, but it is a big important element. And how this plays into BOE base rate expectations. As you can see, the bottom 3 lines were basically the end of last year through to the beginning of, the end of June. And we were expecting up to 3% base rate by the middle of next year. And then unfortunately, the mini budget came along and you can see how much that's completely changed the narrative. We're now very much expecting, well, the market is in general, it's expecting base rate to peak in June at 6%. Obviously, that could have very large ramifications for the UK property market, but we see that tailing off after that point for a long-term average over the next 10 or so years of around about 4%.
But again, contributing to quarter 3 numbers, that is what the market's talking about, published news. So yeah, again, if we hit 5%, that's going to be a positive for some of the factors we've spoken about.
So obviously increasing base rate is very much a negative factor in bond markets hugely. Did you want to talk about this too quick?
Yeah, I can do. Yeah. So yeah, this is just an important chart that we've been tracking. You know, again, I think where we are in many markets, whether that's Europe, you know, UK, S&P, Japan, kind of the same logic of trying to work out where the bottom is in these various markets, and obviously funds of those various markets. We've also had the other deliberation of, you know, in some index funds like in Europe doing better than the active managers because of their tilt towards growth. But we thought this was an interesting chart, and it's one that we're actively tracking and trying to pin what will be the deemed bottom. And again, I stress with charts like this, they're interesting charts, but you know, every cycle has has different conditions, etc. So, and every cycle, you know, every chart can get broken in its methodology. But this is an addition of consumer price index and the trading PE ratio to the S&P 500. And in every other market downturn back to the 1950s, this curve has intersected this line here at 20, which is a simple addition of the trailing PE of the S&P and CPI. So obviously that's still quite elevated there. That to some that would mean we are some point off the bottom, and there's going to be a period where if inflation stays the same, then it has to be the trailing PE that would get lower, which would be negative for equity returns. As Sam sort of touched on there, the other factor in bringing that down is that if this was priced at 9.5% and it drops to 5%, well, you're pretty much nearly there, and then you're only going to have a 1% adjustment to the trading PE. So that's where we actually think that will play out as opposed to that. And yeah, do you want to talk on this?
Yeah, so I just quickly included this morning. So this is literally came through to myself this morning. Very much, this feeds in very much into what I was talking about. We're looking at reasons for the Fed to stop raising rates. And what we've got here is there's data coming through now from business managers suggesting that the amount of people that are planning price rises in their goods is really starting to come down, and actually quite quickly, as you can see. That we were talking literally a couple of months ago at 50%, well, just over 50%. We're now looking at 30%. And similarly, when talking about if we're looking at the jobs data, you can't quite see it as clearly on there. Unfortunately, the white line is superimposed over top of the blue line. But we are seeing it is starting to fall down on the hard jobs to fill that has come down from its peak as well. So we are starting to see those rate rises starting to feed in. And so now we're starting to get to that point where we're starting to look forward to when the Fed stops raising rates, or even next year, possibly even a reduction in rates. And that's actually going to be really, really powerful, I think, in terms of the changing of the whole narrative and what's going on in the markets. And then the previous graph that you showed that Mark talked through, that was talking about backwards looking price earnings. This is more looking forward. So what we can see here when looking over to the far right hand side is where we are now. The thing I'd like to point out is that this is comparing it against a historical average back to 1950, which perhaps is a little bit too long of a set of data. So I've added in this red line, which is going back to the mid-90s, which is probably a bit more appropriate. But you can see that actually we haven't got a huge amount more to look at in terms of decline in the US on a PE basis compared to a more medium-term average. So what are we looking at for the next quarter? So as you will see in a second, China is a significant part of our portfolio and has been for a number of years. With China having their Communist Party Congress on Sunday, matter of fact, it starts. We will be very much watching this like a hawk and reviewing these holdings post-Congress. We're currently expecting them to have a loosening of their COVID policy very much by next spring. If it's going to be any further than that, then that will be seen very much as a negative signal. Furthermore, we're looking at support for the property market over there as well. That's going to be very important, as we are every quarter as well. Period of intense fund manager meeting review. We're concentrating on not just on China, as I mentioned, but also on Japan and the US in particular this quarter. In the US, we've got the midterm elections, so that's going to be very important to keep an eye out at. And one thing as well, because we, as I was talking about there, we might be getting towards, in the US in particular, the end of this raising cycle, might be looking at perhaps rotating our fixed income positions around so that we're better positioned for next year. Quite often the markets actually precede the actual events happening, so we want to make sure that we are positioned right for when that happens, rather than lag behind the rest of the market. And then, yes, I've spoken about currency. I won't go over that again, as it's of course going to be a major part of this. And also looking at when does Europe and UK start to become a buy. Unfortunately, this has slightly changed thanks to the mini budget, but preceding that, we were looking at the peak recession in the UK. We had quite a lot of data coming towards us that was suggesting it was going to be Q2 next year was going to be the peak of a UK recession. at which point that was when we would say that that's probably the buying time. However, the mini budget has changed that quite a bit, so we're waiting for the new information to come in from which to rebase our opinions on that one. Obviously, we don't want to make a decision without being informed what we're doing beforehand.
Yeah, and I think probably just other comments on there. The rotating to the fixed income position. The fixed income part of the portfolio has served us, really, really well. We've at times been underweight 9% gilts. That position changed because lots of fund managers actually, rather than us selling or buying gilts, it was more benchmark constituents selling gilts. So that came down to like 2-3%. But we've been underweight that for the last year and year and a half, 2 years. We're probably a little bit early to the trade, but yeah, that's been a massive protector to portfolios. And again, treasuries with where rates have gone in the US. Those of you in portfolio 1, portfolio 2, a little bit in portfolio 3, have had the benefit again that we were anywhere between 6 to 8% underweight. So it's very easy to talk about our equity positions a lot, and I think the equity positions always get talked about more than the bond positions in the portfolio, and obviously the share currency. But the fixed income part of the portfolio served us very, very well. Our underweight to US Treasuries, we've changed that like in the last couple of days. So we didn't have a view anymore that we needed to be 7-8% underweight Treasuries. So that's a position that's going to go almost back down to neutral. So that's a big portfolio swing for those of you in portfolio 1 and portfolio 2. That's going to be us buying treasuries and obviously getting treasuries issued at new rates of 4% upwards, and those buys making their way into bond portfolios. And the view that we're comfortable doing that more in the we said, do we want to do that in the US and UK? And for us right now, that decision looks obvious. And I've seen a couple of the questions come in that we just wouldn't do that in the UK at the minute based on the last month. So the US, we have done that. How that so that's something we haven't spoken about for years, actually adding and considering adding bond and treasury positions to portfolios. But we've done that this week. And yeah, the portfolio now does have bond replacements in. The Hypnosis fund was bought in much earlier in the year, was very, very robust, has still paid a 6.5% dividend, has since had very fund specific issues around the way that the acquisition of these music royalties are required, and the market basically freaking out that its debt, which has historically been used to go and buy these catalogs, and then the royalty income bed down that debt, as they always have done. They've always bedded down the debt. But obviously it's a very different position having to borrow money at 1% and leveraging up on books. So it is refinance some of that debt, at risks of, I think, up to 6%. We read. We've had two calls with them. We're speaking with them again today because, again, we want to understand why we haven't seen a recovery post the debt refinance that was published. It rallied like 6% in the day. So it's just a very volatile holding. But again, we just remind clients of some of these holdings. Lots of clients are in retirement. They're not in a need to cash these positions out. And likewise, as fund managers, we didn't buy Hypnosis to be in and out of this thing. We bought Hypnosis because we, would rather almost ignore the capital value, collect our 6.5%. That was 6.5% that we've collected for a year, whilst rates have been, obviously rising upwards. But we're comfortable with that 6.5% being held. We have added to the position this week in all 5 portfolios. We did previously hold it in 1 to 4. So we bought it this week, probably at an average of about 88 pence to the pound. Maybe our trades, I think, did actually make a difference, and it rallied to about 93, 94. That's a big trust, but very low trading volume. So I think again it's a patience thing on that. For me, for an investment trust to be trading at close to a 40% discount, as I said, we're scratching our heads on it. So we urge on that position clients to remain patient as we are. we will continue doing our calls. We will continue speaking to the necessary parties at hypnosis. But there's still target prices of 120, 130 out for that. So that's now, it's now 50% rally from those levels. So that now makes up 5.5%. I think of portfolios 1 to 3, slightly less in 4, slightly less in 5. So yeah, in terms of the outlook, that's an important fund to keep talking to your advisors about, because it makes up 6% of the portfolios now. But again, we've tried to be active and buy it at a point where, I say we're scratching our heads, but we're saying that in a positive way, that we believe we sit and hold that for 3 years. It's going to collect the dividend every year, and we want to be up 50% on it, really. And UK buy, we're talking more. We're not really talking about FTSE 100 there. We're more of the view that FTSE 100's had its good year, and we'd have to do something very different. It's also 82% exposed to overseas earnings coming back into the FTSE. But yeah, I think there's now a spread of near 50% between the FTSE 100 and the AIM market. The AIM market being obviously the very domestically focused companies. So yeah, we're more of a view of, we had a price of 7.3. We would have traded on accounts at 7,300 on the FTSE. I think we're down to about 6.8 this morning, so a little bit off that now. So we're probably going to defer that trade. We would rather come out of the FTSE at level we want to come out at, and I think in doing that we'll very much switch that to partly to Rafa, which again has been another good bond alternative holding, and buying into something again with what we believe to have a bit more value over the next 2 to 3 years, but will potentially add volatility short term.
I think it's very important actually that you talked about the UK as well, because that is also something that I think we really have. Well, we've got quite right, especially over the last 6 weeks or so. If I just go to our positions here versus the benchmark, you will see there down towards the bottom, all of the UK segments were very much negative versus the benchmark. So that has meant that when we had the mini budget a couple of weeks ago, and UK assets had very much a strong sell-off, we were a lot more protected against that versus benchmark. So that was certainly a positive element to look at in the portfolio. As mentioned there, China is a significant holding within our portfolio, so that's why we're very much keeping an eye on the Congress over the next few weeks. They are a little bit backwards in the sense of whereas the rest of the world is obviously raising their interest rates. China would actually like to decrease theirs more. The only reason why they haven't is because they don't want to devalue the yuan anymore versus the dollar. However, if the dollar strength comes back a little bit, I would expect China to reduce their interest rate a little bit, which will of course help support the equity market, etc. So yeah, obviously I'll let you all digest that in your own time when we send these slides across to everyone. But yeah, I think
yeah, apologies that we thought that was going to be 20 minutes and we've hit 40 minutes, so
sorry,
obviously talking a lot on those points. I'm going to jump to some of the questions that have come in, and Sean, if you can enable questions or comments after that. So I'll ask Neil just to clarify his question a little bit further in a minute, but second question from Roger is, what is the percent exposed for AWM and CBAM exposed to dollar and euro? So that ranges from 14% in portfolio 1 up to a massive 42% in portfolio 5. That's just dollar. And then euro positions on top of that will be anywhere between 6% to, I think, probably 14% in portfolio 5. The euro one hasn't really been a factor, because it's not hedged, and there hasn't been such a deviation, as Sam touched on. The deviation has been in dollar versus everything else in the world. So that's the one. That's the one that's affected, our particular portfolio returns, because we haven't benefited we haven't benefited from the dollar strength. We haven't lost anything in clients' asset values, because that is what the hedge on the US does. But we haven't got that revaluation of assets from a dollar strengthening on the US portfolio. So that's that question. We touched on this already. A question from Glenn Davis. Any thoughts on presidency reinforcing his thoughts on zero COVID policy this morning? I mean, our hopes of the conference was that the policy was going to be lifted. I think, as I touched on, China has had a terrible month performance-wise. So I think, again, news and thoughts on this always feeds in before. And, as much as there's always talk about property sector and stuff in China, it looks like it's not going to be a 2022 thing that eases. But again, that's why we've had like another 10% sell-off in Chinese equities. We haven't held the HSBC fund from the top. We bought it about halfway down, but that fund is nearly down. I think it's down like 58% at this morning's levels, which again, I look at something down 58%, and either if that was a single stock, you'd think the world, you'd think that company would have serious problems, but we don't hold single stocks, we hold funds. So for me, there to be a 60% discount to a Chinese market, it's frustrating. Like, we've tried to be patient on the position, but I don't think it'll be at 60% down level in 2 years' time.
No, I said China's working kind of a little counter-cyclical at the moment, so I would expect China to soon start to perform a bit better. So yeah, as I just answer this one, Graham, I think this also goes along with the earlier question about the fire sale of assets. So yeah, as I mentioned on the versus benchmark, we are very much underweight UK gilts, but also UK assets generally versus the benchmark. As a matter of fact, as of the rebalancing process that is happening this week, we are reducing that even further. So we are, compared to an awful lot of people, we are very much a lot less affected by this.
And I think the second part of the question is more an advisory question, but I'll answer it. So any DB schemes affected by it? All DB schemes up to 32,000 of income are 90% protected through government's own protections. So they would be bailing out they would be bailing out those pension schemes up to the first 32,000 of income. The SIPs don't have that because they're not. If they've moved out of the DB into a SIP, they haven't got that 90% protection that's purely for the defined benefit pension market. So the SIPs would purely be affected by market movement, which was more related to Sam's comments. Rob Agnew, what is the estimated percentage fall needed? I'll give an estimate on that, but there's so many different factors in that question, because, as I say, if CPI fell 4%, there'd be a view that the S&P wouldn't even have to drop.
It's about 5% in that situation if CPI dropped about 4 percentage points. As if inflation stayed exactly as it is, it looks alarming. It would be another 15 to 20%. However, inflation is not going to stay at 8.5%. Even in the short period, you're expecting, even on a moderate basis, looking at say 5% inflation within the next 6 months. That's then a lot more palatable on that rule of 20.
And remember, that is US, because it's going to again have a very different path for 2023, as it has established a different path for itself for 2022. So yeah, that was all the written questions. Happy to take any other written questions, or people should be able to unmute themselves if needed.
I've got one more.
Seems like someone's typing there, but please do feel free to unmute yourselves and ask directly to Mark and Sam.
Okay.
All right.
Well, maybe we spoke too long to prevent there being questions, but yeah, we did want to open the floor, but no, yeah, we appreciate clients' patience. Hopefully, hopefully communication with advisors has been good, and as I always stress it, we speak to clients more in these times than in good times. That's just the nature of the business. But yeah, if no other questions are coming in, hopefully we've pinpointed what have been the disappointments for the quarter. It's stuff we're looking at every day. We need a currency reversal. Hypnosis will probably put a written note out on that. I think we've had a couple of meetings with them. They were very, very relaxed in their last meeting. I probably don't want them to be quite as relaxed in the next meeting, but perhaps we'll put a note out to clients specifically on hypnosis, as we've now increased that position to 5-6%. We'll also explain the way we executed that position, because I joked about it being a 2 billion investment trust, but us putting a couple of million of orders into the market does actually make a difference. So again, we do put that extra effort into trade execution. If we execute something and it doesn't feel right to us, we always try to get to the bottom of it. And yeah, the trading volumes of 2 billion investment trust are light, so we've even tranched that in over three buys, so over like the last 10 days. But yeah, thank you very much for attending. Please, give myself or your advisor a shout for anything else in the coming weeks and months. But yeah, otherwise, have a good quarter, and we'll speak to you through Christmas.